To incorporate or not, that is the question. The two main reasons are tax savings and liability protection. If you do business as a sole proprietorship, there is no distinction between the business and personal assets. If a judgment is awarded against the corporation or business, any personal assets of the owner can be used to satisfy the judgment. Another setback of the sole proprietorship is that it can't survive without the business owner. Now, LLCs, on the other hand, can be used to hold properties and conduct any type of business. The LLC structure are similar to sole proprietorship, general partnership, limited partnership, subchapter S corporations, and trusts. The LLC is a flow-through entity. It passes all of the LLC profits and losses directly to the members of the LLC. Individual members are then taxed at their personal tax rate. Nevada statutes only requires one individual or legal entity to form an LLC. However, the IRS has the ability to tax the one-member LLC as either a corporation or a partnership. In most cases, the decision to structure as an LLC is driven by the desire to have profits treated as pass-through income for tax purposes. Your partner in the LLC can actually be a corporation you own. In other words, you can be your own partner. Let's compare C corporations to S corporations. Corporations vary in their structure and organization. A corporation is not just a corporation. You will need to select from various types. The two typical corporations that most CPAs or attorneys will recommend are S and C corporations. S corporations allows for limited liability of the owners, officers, and directors. Typically runs on a calendar year, requires full disclosure of corporate owners. Profits pass through to the individual tax return or 1040. No tax brackets separate from the personal tax brackets apply. All profits are taxed on the owner's income tax return, even if not distributed. C corporations, on the other hand, allows for limited liability of the owners, officers, and directors, allows an unlimited number of stockholders, runs on a fiscal or calendar year. Profits can be kept as retained earnings. Profits are taxed at the corporate rate, which is usually lower than the personal tax rate on individual returns. Subchapter S corporations, there are certain qualifications that the corporation must meet in order to elect S corporate status. It must be a domestic corporation formed in the USA. It may not have more than 75 stockholders. It may only have individuals, estates, or certain trusts as shareholders. It may not have a non-resident alien shareholder. It may only have one class of stock. An S corporation operates on a calendar year basis. Things to consider when electing an S corporations are: losses flow through the corporation. They can be used to offset active income from either spouse. If the S corporation earns active profits, the profits can be offset by losses from other businesses and operating expenses from a sole proprietorship. There is no double taxation. Who should use the S corporation status? Companies expecting startup losses during the initial years of operation. Companies with no intent of going public in the future. C corporations, on the other hand, have a different tax rates than individuals. In many instances, C corporations will pay less taxes than individual. C corporations have no limitations on shareholders. Shareholders can live anywhere in the world and can be any type of entity. They will give you the most flexibility and are recommended in most instances. The only thing you will have to be concerned with when using a C corporation is double taxation. Eliminating or deferring profits through proper financial management can easily deal with this problem. Double taxation typically only occurs with large corporations who have several stockholders that need the profits distributed to them at the year end of the corporation. The owner of a corporation can decide at the end of the year what to do with the profits. They can distribute them to the owners in the form of a dividend, pay bonuses which are tax deductible to the corporation, keep retained earnings, or have a retirement plan that profits are distributed on a tax deferred basis. Retained earnings can be used for future growth of the company. additional investments in equipment, buying another company, advertising expenses, etc. When the corporation has retained earnings, these profits are taxed at the corporate level, left in the corporation and not distributed to the owners. If the corporation's owners or officers need the money for personal expenses, they can be paid as a wage in the form of a year-end bonus or set up a retirement plan to expense as much of the corporation as possible. The IRS says that it is the responsibility of the taxpayer to lower their tax liability. They also say that a corporation can deduct any general-related business expense to lower their tax liability. This can be achieved by using good money management. Asset protection is very important. It doesn't take a catastrophic lawsuit to wipe out everything you own. There are many common business events that can equally affect small businesses, leaving owners' personal assets fully exposed. Tax savings and the myriad of tax benefits that can be achieved by utilizing a corporation outweigh those available through the use of any other business structure. For example, corporations are entitled by law to many deductions not available to individuals. Many of the tax benefits available to a corporation can greatly benefit corporate owners. Even without considering these differences, you can see that at income levels up to $100,000, all else being equal, the corporation would pay less federal income taxes. It doesn't include the impact of self-employment tax, paid as a sole proprietorship, or any state income taxes that may apply. It impacts the bottom line, which delivers more dollars, increasing sales, reducing costs, or cutting taxes. It may surprise you that a tax dollar saved is much more valuable than an added sales dollar or cost-saving dollar. A tax dollar saved is a full dollar retained in the business. The federal and state governments can take a tax bite out of every other business dollar, whether it's a dollar that was retained by reducing costs or a dollar that was brought in by increasing company sales. Audit reduction is important. The minute you incorporate, your audit risk is dramatically reduced. The IRS puts more emphasis on sole proprietorships than on small corporations when it comes to audits. The IRS audits 10% of all sole proprietorships and 1% of corporations with assets of less than $1 million. The IRS sees an individual operating as a sole proprietorship, also is operating as a general partner, to be less sophisticated than businesses operating as a corporation. The IRS also assumes that due to the fact that they are operating one of these two ways, they are more likely to make mistakes on their return. Operating your business as a corporation means you have a higher sophistication level and are less likely to misrepresent items on your taxes. In general, small corporations are less lucrative to audit because they are allowed more deductions and are taxed at a lower rate than sole proprietorships and partnerships. Living the corporate lifestyle as an officer or owner of a corporation, you should take advantage of living the corporate lifestyle. Why use after-tax dollars to pay for your automobiles, travel, computers, office equipment, certain utilities, and even your kids' college education, if these expenses relate to a business purpose and can be purchased with pre-tax dollars through your corporation? A corporation can be structured so that your company can pay for any expenses that have a business purpose. Why not use this to your benefit? Sports arenas rely on corporations to pay for the VIP boxes to watch their sporting events. As the owner of a corporation, you can win big by taking your clients and employees to those events and doing it all with pre-tax dollars. Or why not join the country club with a corporate membership and golf every day with no money coming from your pocket? Just make sure that you take your favorite client along and lock the date, so if you're ever questioned about it, you will have documentation to prove it. Many other expenses can also be paid by a corporation: education, legal and accounting fees, insurance, moving expenses, seminars, books, meals, entertainment, and much more. With these tricks, you will find you don't need to be paid as much salary and will have lower personal tax liability as well. Doesn't it sound like it's time to start living the corporate lifestyle today?